In this session, you're going to see what options are and a couple of their characteristics. There are two kinds of options, calls and puts. Buying a put option gives you the right to sell a stock at a certain price and for a certain amount of time. And buying a call option gives you the right to buy a stock for a certain price and for a certain amount of time. Now, the really cool thing about that is you no longer have to be attached to a certain market direction. If you think a stock is going to go down, you buy puts on it. And if you think a stock is going to go up, you buy calls on it. You can buy calls or puts on stocks or entire indices like the Dow or the S&P 500 or the NASDAQ. But the trick with buying and selling options is that you have to be right on your timing. The reason is all options expire at some point, but the good news is you can buy as much time as you think you'll need. You can buy several months of time if you want, or in the case of LEAP options, which stands for long-term equity anticipated securities, you can buy over a year of time. And on the short end of things, many heavily traded options now have weekly options, so you can buy just a few days of time if you want. The point is, you have a lot of flexibility on your time. Just remember that more time costs more money. The other characteristic of options is the strike price. The strike price is the price that you agree to buy or sell at. So for example, say a stock is $47 and you think it's really going to go up over the next couple of weeks. You can buy a call option at the $50 strike price for say a month of time. That gives you the right but not the obligation to buy the stock for $50 anytime over the next month. Now, when I explained this to my dad many years ago, he said, why on earth would anyone buy an option to purchase the stock at 50 over the next month when they can buy the stock right now for 47? As I explained to my dad, there are two reasons, leverage and potential. The leverage part is that instead of paying $47 per share for the stock, you might be paying, say, $1.50 per share for the option. That's a huge whopping difference. If you want to control 1,000 shares, it's the difference between putting $47,000 at risk versus just $1,500. That's a big deal, especially if you don't have a lot of money in the first place. The second reason to buy the option is potential. For example, in looking at the chart and seeing what kind of news is coming up for the stock, you estimate this $47 stock is liable to climb $5 over the next 2 weeks. If you buy the stock and it goes up $5, that's a 10.6% return. Not bad for just a couple of weeks. But if you buy the option for say $1.50 and the stock goes up $5, that means the stock is now 52 bucks. Well, if you own the right to buy the stock at 50 and the stock is 52, your option is going to be worth at least $2, the difference between the strike price and the stock price. But if there's still a couple of weeks of time left on the option, it will have some time value left on it as well, say another 50 cents. So now your option is worth $2.50 and you only paid $1.50. That means you were up $1 on a $1.50 investment, or a whopping 67%. That's a far cry better than the 10.6% return you would have made by buying the stock. In a nutshell, that's why people buy options, and it's important to know the right strike price to buy, and that's what we're going to take a look at in our next video.